Hi, and welcome to a heart-to-heart one-on-one discussion on the consumption story in India. So much has been said about it, so much has been written about it. Let us try and decode today. So, Abul, hi.
Hi.
Today I'm going to pick your brains on one of the most widely spoken about, talked about, and probably overutilized theme that we've seen in the equities part, which is essentially all about consumption. Now, first off the bat, when you look at the Indian economy, especially in the post-COVID era from 2020 till about 2024-25, India was primarily being driven by investments, right? So we saw government capex rising by 20-30% year on year every single year. What was probably in the region of 3 to 4 lakh crores shot up in excess of 10 lakh crores over a very short span of time. And that is essentially what was propelling the economy at 6% plus pace on a sustainable basis when the whole world was kind of falling apart in front of us. Now we've reached a point where fatigue has started setting in as far as the investment part of it is concerned, and we need to pivot to the consumption side of the economy to drive the growth going into the next 3-4 years. Do you think we are ready to make that shift? Do you think that we are there? Do you think the actions that are being taken are in the right space? And do you think RBI as well as the government of India are doing enough to enable this transition?
So in the last 4-5 years, most of the heavy lifting has been done by the government in terms of capex. But if you start from the events budget, which was presented in early part of the year, the tax rate cuts that have happened, then you have interest rate cuts of more than 100 basis points cumulative this calendar year, and you have liquidity infusion, then in fact bringing down the regulations in the lending space. All these things actually are being done to propel the consumption in the economy. While capex at 10.5 lakh crores by the government, and last year if I look at the listed companies in India, capex has surpassed that number at 11 lakh crores. So private capex is happening now. And government now wants, with the interest rates coming down, liquidity being infused in the system, government now wants the private sector to do the capex and to propel the consumption in the economy. And with the inflation remaining low, the real interest rates are at a pretty decent level, which is actually very good for the consumption to pick up in the economy.
So tell me one thing, that we've seen revenue growth in the last 3 or 4 years growing at a very decent pace, right? There has been not really up to the expectation, it's still being driven largely by margin expansion story, but yet revenue growth has been there. And we've seen capacity utilization levels rising through the year successively. And yet it has not resulted into private sector capex coming through in a way that most people were talking about or envisaging it for the last 4-5 years. What exactly is the reason for that happening? Is it a lack of visibility or confidence in the consumption story playing out over the next 3-5 years, the sustainability of it? Or is it that people are pivoting more towards internal cash flow funding rather than taking debt on the books? So is it a behavioral change by the corporate, or is it that lack of confidence in the growth?
I don't disagree that I don't agree to the point that private capex is not happening, because if you look, I alluded in the earlier to the answer for the first question. I said 11 lakh crores capex by the listed companies, and a very healthy growth, double-digit growth in the capex by the listed companies, where actually a lot of it has been also done by PSU companies. But people believe that most of the capex that was coming in should have actually lifted the credit growth from the industry. That has not happened, because all these companies during 22-23 have improved their balance sheet so significantly, and their capex and their cash flow generation has picked up so significantly that most of the capex is happening from the internal accruals. And that's the reason why it was not reflected in the credit growth. Given that the capacity utilization in the economy is at 75%, and government is doing everything possible at this point, in fact, it's gone on a hyper mode to push the consumption in the economy, it's just a matter of time when that capex starts picking up and getting reflected in the credit growth also.
So what you're trying to tell us is that private sector capex has been happening. It's not like as if it's not happening. It's just that it's not getting reflected in the credit growth in the way that it should have. Point well taken. Now, you mentioned very interestingly that we are at the juncture, we are right at the cusp of the V-shaped or U-shaped recovery in consumption. 2 questions: urban or rural, or staples or discretionary? What would your pick be?
So I would be more inclined to play it through the discretionary capex.
Okay.
Rural consumption, which was actually lagging for quite some time, has seen some shoots of recovery, green shoots happening there in recovery in rural consumption, but is still not up to the mark what I would have expected at this point in time. Urban capex, if you look at most of the discretionary categories, jewelry, hotels, hospitals, autos, all these numbers are pretty good and pretty healthy at this point in time. So I would be more inclined to play it through the discretionary consumption. FMCG consumption, especially the large FMCG companies in India, they are losing some of their share to the direct to consumer brands. So the moat that these guys had till 10 years back in terms of their very strong supply chain, their reach to the rural hinterland. So if you go to 10 years back, the most important discussions that happened, what's the reach of a FMCG company? Now that reach can be achieved by anyone through DTC. If you look at Swiggy, Zomato, all these guys are selling a lot of direct to consumer, which is eating away the share of these organized, big, large consumer companies. It's not that that consumption is not happening. Consumption is happening, but it's not getting reflected in the listed large companies. It's going distributed to the other smaller D2C brands.
In the staples part.
Yes, in the staple parts. In the discretionary consumption space, if you look at jewelry, very strong growth being reported by all players, despite gold prices being very high. In a normal scenario, it was said that when gold prices move up significantly, the demand goes down, but that's not happened. So discretionary categories are all seeing demand.
So two questions over here. You very rightly mentioned that discretionary consumption, electronics, white goods, brown goods, jewelry, hotels, hospital, travel, tourism, leisure have been kind of taking off in a way that they should have, or rather we expected them to. But how much of it is being driven by one of the two factors or maybe both of them? Number one is a movement from unorganized to organized, which is happening, particularly in sectors like jewelry, where we've seen, the movement in the last few years have been, the share of organized has gone up from 7-8% to 30-35% today. So it's been a big move over there, number one. Number two, is it that in general mass affluency is creeping in, or rather the propensity to consume is increasing and the propensity to save is on a declining mode? Which out of the two factors do you think is a major contributing factor for this push in consumption?
So
remember, our GDP per capita has almost doubled in the last 10 years and is expected to double again in the next 5.
So a large part of this consumption, discretionary consumption companies like jewelry companies, hotels, electronics, and all these companies are doing better because of the shift from unorganized to organized. Large part of that is there. Of course, with our propensity to consume is moving up. If you look at the unsecured loans, credit card loans, personal loans, all these things are growing significantly.
20% plus CAGR over the 3-year period.
Yes.
Absolutely.
And so that means propensity to consume is moving up, but in discretionary space, still a large part of the consumption large part of growth of the discretionary consumption companies is being driven by shift from unorganized to organized. Look at apparel sector. It's a pretty huge, large sector in the country. Still 60% of it's unorganized. So if the companies are putting their strategies right in their space, they are growing at a hyper pace of 30, 35, 40%. Even 50%, a lot of the retail companies are growing at that space, apparel retail companies. So there is still a lot of unorganized to organized shift which is going to happen in that space. While if you put that analogy in FMCG space, if you non-discretionary consumption, if you look at, share is being eaten away by a lot of D2C companies. Here it's unorganized to organized shift happening. So it's happening the reverse in this space, which is helping the discretionary companies, large discretionary companies in India.
So what I'm gathering from all this discussion over here is that A, you're bullish on consumption, B, you're bullish on discretionary consumption, and C, you're more bullish on domestic driven discretionary consumption stories, right? Which is essentially the classic India story that we've all grown up to, where the middle class is expanding and consumption is booming through the roof. Okay, which is a fair point. Now, how are you playing? Which sectors are you focusing on in your portfolios when you're looking to play these consumption stories? Where is it that you are maintaining a heavy position in terms of weights?
Yes. So if I look at portfolios in the fund management business, we are more inclined to play it through hotels, hospitals, apparel retail, jewelry retail. These are four big themes that we are playing in the portfolio. We are still not very keen to play the auto themes because a lot of that positivity in that theme is being now priced in the stocks. FMCG space, although I expect that consumption also to pick up, but if you look at the last couple of years, every single quarter, these companies are delivering a single-digit earnings growth, all these large FMCG companies, and their valuations are still like 50 times 1 year forward, 55 times 1 year forward. So for a single-digit earnings growth, it's very difficult to play that kind of valuation.
The risk-reward doesn't match
the risk-reward doesn't match up. It's just that the history was too good for these companies. Between 10 to 20, these earnings were growing in double digits. So everybody thought that buy at any valuation. That
the penetration story is playing
out. That theme is actually not playing out now. So now there is a lot of other alternatives available in the market. That's the reason why you're seeing these large FMCG companies are not doing that great at this point in terms of their stock price performance. And also their financial performance is not that great because there's a lot of share being eaten away with D2C companies.
Okay, 2 more questions and then I'll let you go, promise. Number 1, are you also playing the consumption theme through food technology space or through the quick commerce space? Have you started looking at that in a big way, the new age technology companies as we speak? You mentioned that earlier. Or are you looking at that going into the next 6 months, 1 year? Is that something which is there on your horizon? Yeah, so if not, then why?
No. So I have looked at those companies, but I would be honest to admit that I am not able to appreciate the kind of estimates that people put in on those numbers. I'm not able to visualize 5 years down the lines what the profit of these companies would be. That's the reason why I'm not playing those companies in our portfolio in the discretionary PMS business at this point in time. While non-discretionary fund, there is certain themes that we are playing, but in the discretionary space, being an old economy guy, I think I'm not able to appreciate it. Maybe I have to pull up my socks and try to put my vision 10 years forward and look at those companies. But at this juncture, I would admit that I'm not being able to.
So there's a little bit of a euphoria being built in both the earnings estimate as well as valuations, yes, is what you're telling us. Okay, last question. How sustainable is this theme of consumption, discretionary, domestic-driven consumption in India? Is it a 1 year story, 3 year story, 5 year story, 10 year story? What's your view on that? How should our investors be looking at it? Is it a buy and forget and hold for a long-term story, or how are you playing it?
So, best of the money is buying and then tracking that stock throughout this journey. My sense is the discretionary consumption space in India can grow for multi-years. If not 20 years, at least 10 years down the line. I still believe there can be double-digit growth in a lot of these discretionary companies. So we can play that through that. But of course, given the kind of liquidity that's around the system, a lot of the growth for next 5 years is getting priced in today. So you need to be very, very careful to book in your profits. We as a Centrum, as a philosophy, we have a very clear fair value approach to a stock. If we believe that a fair value of a stock 2 years down the line, say 100, and it is achieved within a year's time or a 6 months' time without any new developments happening, we'll rather book our profits out there. We may still hold the stock in the portfolio, but we'll trim our weights, manage the risks, and see how the things pan out.
So there you heard it, guys, from the horse's mouth yourself. Consumption as a theme is relevant today. The economy is pivoting towards consumption. There's a concerted push from the government side. There are enough opportunities which are available. So do have a look at it and happy investing.